right. Welcome to the show, everybody. We are remote, as you can probably tell. Jerry's off in warmer places than I am, anyway. It's freezing here, but yeah. So we are. He's in a dark cave, undisclosed location, doing fun things. I hope, but he'll be back next week, and then we'll be back here in the studio. But yeah, welcome, Jerry.
Well, it is good to be here remote. I am not in Charleston, South Carolina. I was a few days ago, and now I'm down in Florida, where, to be honest, it's a little bit warmer than it is up there, but not by a lot. It's pretty cool down here as well. Anyway, we got a lot to talk about this week. One of the things we were just chatting about a little bit is that the market continues this range-bound consolidation. If you look at a chart of the S&P 500, it's gone sideways almost to the dollar as we're talking here since the high on December 6th. So it's been a couple of months of sideways consolidation with several attempts to push above that level, and it just can't seem to do it. And we're going to kind of keep coming back to that throughout a couple of things I'm going to talk about, because there's actually an article that I'm gonna share here that says, hey, it's kind of make or break time for the S&P, because we're going into a difficult seasonal time period. So we'll get to it. Anyway, TSP Weekly Podcast, 23 February 2025. So we'll talk about what happened this week, a little bit about restructuring the debt and how important the federal debt is right now. The clock is ticking. That's what I was just referring to about the S&P needs to make a move here. And then we're going to talk a little bit about gold. I'm doing a pretty long piece that's going to go out on the email that attaches to the newsletter about some things that have been happening with the current administration and gold. People have probably heard about the audit that Elon Musk and Rand Paul are calling for. That was big news this week. There's a lot of interesting stuff that revolves around that. So definitely check it out in the newsletter. And then we'll look at the TSP fund charts. So this week, Monday was a holiday, Washington's birthday, so markets were closed. Tuesday, we got the New York Empire State Manufacturing Index. It explodes past expectations. It was up 5.7 versus an expected -1. Which means manufacturing, at least in New York State, is definitely improving. And the S&P was up 0.24% on Tuesday. So this is the important part of it, right? This is a 5-year view of New York State Manufacturing Index. And so when the line is above 0, manufacturing is positive. When it's below 0, it's negative. And so they talk about how all the indicators that, there are a ton of recession indicators that triggered over the last couple of years, and we didn't get a recession. So how can that be? There are basically two parts of the economy. There's the manufacturing side and the services side. And so this is the manufacturing side for New York State. So it's not the whole country, it's just New York State, but it's kind of a good example. So, since the summer of 2022, we've been in a manufacturing recession. We've been negative throughout that whole time, right? A couple of ticks above it, but we've been negative that whole time. But the important thing, at least the hope the important thing right now is that the recent trend is up. So if we get, a cup kind of formation here, we had a breakout over the last couple of months, pull back to test it, and then if we keep going up, that's really positive for manufacturing. So we come out of this manufacturing recession, like that half of the economy. That's for New York State. It's not the whole country, because the next one is the Philly index, which is not anywhere near as good as New York. So on Wednesday, mortgage rates dropped a little bit, 6.93 versus 6.95 last week. But mortgage applications were down 6.6% versus being up 2.3% last week. So housing still a problem. S&P was up 0.24%. On Thursday, we get initial jobless claims were 219,000, so a little bit higher than last week, which was 214,000, but it was better than the forecast of 220,000. So still not a big or unexpected uptick. Unemployment rate stays the same. That's the big number to watch, is the unemployment rate. But this is what I was talking about. Philadelphia Fed Manufacturing Index fell to 18.1 from 44.3. So huge contrast in Philadelphia versus the New York index. S&P was down 0.43% on Thursday. And at some point here today on Friday, we're going to get the global PMI, which is the composite of both manufacturing and services. We'll also get existing home sales and a whole bunch of Michigan consumer expectation numbers. So it'll be interesting to see what happens. The S&P, the last time I looked this morning, I mean, right now it's about 1015. S&P was down about a third. So we'll see how it ends. Okay, restructuring the debt. So the debt obviously is it's almost $37 trillion. It's more important is the percentage of GDP and how we allocate tax dollars to go to the different spending that we mandatory spending versus discretionary spending. This is a really good article in US Bank. I'm not going to go through the whole thing, but I pulled out a couple of the most important parts from that article. But the impact of US national debt on your investments. So the new administration, burgeoning federal government debt takes on greater visibility. We're at 36.2 trillion, but over the past 15 years, the debt has doubled. Okay, so since 2009, basically since 2009, the debt has doubled. And policymakers, both inside and outside the government, are warning of the potential negative consequences should mounting debt continue up. But importantly, until now, the surging national debt has yet to notably detract from economic growth or market or capital market performance, right? The market is not going down yet, even though the debt obviously is increasing at a faster rate than usual. After 2020, so this is another kind of important one, right? After 2025, reduced tax rates set by the 2017 tax cut and the Jobs Act are set to expire. So the reduced tax rate is set to expire, which means the tax rate is going to go up, which is bad for us as taxpayers, but it's good for the government because it will decrease the deficit, right? There'll be more revenue going into the government. However, the current administration, right, in Trump's first term, he reduced that rate with the 2017 Tax Cut Act, and he's trying to get that to be permanent. So if he is able to get that to be permanent, then the government does not get an increase in revenue. So markets are aware of the issue, but not fully prepared for it, says Rob Hayworth, senior investment strategist for the director of US Bank Asset Management, right? Bond markets are where investor concern over rising debt will be most visible. Yields on the 10-year US Treasury note are hovering around 4.5%. And he says it may reflect some market uncertainty about continued debt growth. It's a very, very big issue. That's why we keep harping on the 10-year yield. Rising costs associated with federal government's large accumulated debt add to the challenge. Interest rates jumped significantly beginning in 22. As a result, interest costs on the debt are a larger component of federal government spending. Average interest rates for all government issued interest-bearing debt has jumped in recent years to 3.28% as of December 31st. So it's more than doubling the average interest paid in 2020. Okay, the next article kind of goes to this, which is really what I wanted to emphasize. It says the average interest rate of all federal government issued interest-bearing debt has jumped in recent years to 3.28%, right? That's more than double the average interest paid in 2020. So we know that a big portion of our spending, national spending, it goes towards repaying the debt. And so if the interest on the debt, if the interest doubles, you're paying a lot. It's like your credit card doubling. It's like the rate on your credit card doubling. Okay. So this is a really good paper from NAF Insights. It's on LinkedIn. So if you guys want to see it, that's where it is. Market continues to be rife with uncertainty as the price of gold hits all-time highs. Although the 10-year Treasury has returned to its lowest level since December 18th of 24, fixed mortgage rates have fallen below 7%. But we should expect a lot of volatility ahead. I mean, that's a certainty in 25. There's going to be a lot of volatility. This is the important part that I was just talking about. This year, the U.S. faces a massive $9.2 trillion in debt that will either mature or need to be refinanced. So to put things in perspective, the total outstanding debt currently sits at $36.2 trillion, which means 25% of the total is set to mature to the short-term, due to the short-term nature that the government has been issuing debt to finance its deficit spending. So the Treasury, in the last administration, the Treasury has been issuing a lot of 2-year Treasury bills instead of 10 or 20 or 30-year bonds. So they're financing the national debt with shorter term duration instruments, which means they have to be rolled over. And so if the rate was 2% 2 years ago and now it's 3%, you've just increased the amount of interest expense that you have. And so since 25% of the debt has to be refinanced, the amount that we're going to have to pay in interest on that is going to go up a lot, right? So much of that 9.2 trillion in debt was borrowed at a time when rates were significantly lower. Now, if the government decides to refinance that debt, which they will have to do, they will have to do so at higher interest rate levels, causing debt service costs to soar. Assuming all this debt does indeed get refinanced, the average rate on the debt is set to jump by approximately 1%. The window of time for this to occur is between January and June of this year, as nearly 70% is set to mature in the first half of 2025. That alone is going to cause a lot of volatility in the market. It's a really big deal. Okay. That's it for debt restructuring. It's going to be a really interesting thing to watch as the year progresses. All right, the clock is ticking. So this was a CNBC article from a couple days ago. The clock is ticking on stalled stock market to make a move or break down. Right, make a move meaning to the upside, or it's going to break down, says this chart analyst. So it may be make or break time for the stock market based on the charts. BTIG Chief Market Technician Jonathan Krinsky says the S&P 500 has gone a full calendar year without making a downside test of its 20 or 200-day moving average. That's a key level watched by traders to gauge an asset's longer-term momentum and trend line. S&P closed at 6,066 on Monday. That's 7% above its 200-day moving average. Recall that every time since 1990, the S&P has gone a calendar year without testing its 200-day. It did so in the following year, with 3 of 5 times occurring in Q1. Okay, so every time since 1990, the S&P has gone a calendar year without testing its 200-day moving average. It has done so the following year with 3 of 5 times occurring in Q1. That's where we are right now. He added that another factor is conspiring against the benchmark at the moment, making a downside test more likely, and that problem is worsening seasonality. Seasonality quickly turns negative as we head into next week, which is this week we're going into right now. And we are seeing some more deterioration out of pockets of consumer stocks. As we get into next week, the seasonal backdrop turns negative through mid-March. We continue to believe the clock is ticking on a 200-day moving average test. He points out that the S&P has been unable to make a meaningful move above 6,100. That's what we were talking about at the very beginning. On December 6th of last year, we hit basically 6,100, and we haven't gotten above it. It's below it now. It's been sideways since December 6th. So this challenging backdrop comes as traders try to navigate an evolving global trade landscape, which could pressure corporate profits. So I put this chart together. This is the 200-day moving average line that he's talking about in green. We are right now roughly 7% above that 200-day moving average line. It's kind of hard to see it on this chart because that wasn't the point, but we have basically gone sideways since this peak in December. And all these circles on the chart are basically February and March. So there's a little bit of variability from year to year, but they are the first quarter corrections that we have gotten every year since, at least in this case, goes back to 2016. So we have a lot of things lined up where we should expect at least some kind of pullback. And at least that analyst is saying the pullback should take us back to the 200-day moving average line. I put up this chart. I don't know if I've done it on the podcast, but I've done it on the newsletter for the last couple of weeks. It's just another reaffirming of the concern that we have right now. If this is point A, B, C, and D, the length of AB is the same as the length of CD. That's a lot of times we get a reversal or certainly resistance at when AB equals CD, right? So we had a major bottom at COVID. We came to the top in 2022. We had a major bottom in October 2022, and now we're at a top, and we've been there since December. This is the Fibonacci extension at 2. The most common Fibonacci extension level to get resistance is 1.618, and we got that right here, right? For a couple of months, we hit resistance there, and then the market broke through. So the next Fibonacci extension level is 2, and that 2 intersects basically exactly with the ABCD. So that's a really strong target to expect resistance and or a reversal level. And we've been sitting on that target since December 6th. Okay. So does the market go up from here or does it roll over? Nobody knows. But there's a lot of resistance right now and a lot of concern for the next couple of months. Gold. Not really going to talk about, like I said, definitely read the newsletter because we're going to talk about a different thing about gold than what we're going to talk about here. But for kind of teaching purposes, right? This is a pretty long-term chart of gold. It's a daily chart, but we're going back to 2019. So this is a head and shoulders bottom. So even though this is a little bit not really confusing, but a lot of times when you get a head and shoulders bottom, the market is going down, right? The market comes down, goes back up, comes down, goes up, comes down, and we get a head and shoulders like that, right? Left shoulder, head, right shoulder, neckline. When we break the neckline, price goes higher. That's ordinarily what a head and shoulders bottom looks like. But it doesn't have to come from a declining trend. You don't have to have a declining trend and then the head and shoulders and then an uptrend. In the case in gold, this is a long-term head and shoulders bottoming pattern, but it's a consolidation from the big move up that we had, right? That started sometime back here, before 2019. So we had a run up, a peak in 2020. We have a pullback for a left shoulder, came back up and retested that high, a pullback for a lower low, which gave us the head, another pull up to that neckline, then a higher low, which gave us the right shoulder, and a very clear breakout of the neckline right there in early 2024. And then gold took off, right? So if you had been watching the chart of gold and you saw the head and shoulders pattern and you saw that breakout, right? This is a long term, this is going all the way back to the peak in 2020. So it's a 4-year base and a breakout. It was a great looking chart, right? So that's what a really, really good example of a head and shoulders consolidation pattern. So that's just kind of the technical analysis of it. When people think about gold, they think that gold is a hedge against inflation. I think that's probably the biggest I don't know thing that the mainstream media puts out, is that the idea is that gold is a hedge against inflation. So what if you chart gold, which is the same chart that we just did, against inflation? So the red line is inflation, right? It's the year-over-year inflation from the Bureau of Labor and Statistics. So what I thought was kind of interesting is that inflation, say starting in 2018 at some point, inflation is coming down, right? Gold is going up. Here, inflation is going up, gold is going down, right? If gold is a hedge against inflation, then when inflation is going up, gold should be going up. And we're seeing the opposite of it, at least all the way back to 2018. So I'm just kind of dispelling the myth that gold is always a hedge against inflation, because obviously it's not. And inflation can come down, right? And gold goes up. So basically, just to say that looking at the chart is way more important than listening to what they say on the mainstream media. Okay, TSP fund charts. So here we are in the C fund, and again, we build these charts in stock charts. Okay, so the way we build these charts, we build them so that these are the actual numbers, actual TSP numbers. So if you look at tsp.gov, as of February 20th, that's the closing price, 96.82 for the C fund, and it includes dividends. So if you look at a chart of the SPX or the SPY on TradingView or stock charts, the chart looks a little bit different, because the chart of the TSP includes dividends. But we have the 20-week average line. Each one of these ticks is 1 week of price movement, and we get the relative strength indicator down here. So probably the biggest takeaway from, well, two things, right? As long as we're above that 20-week moving average line, the trend is up. Okay, so on the basic level, the trend is up. You can look at this chart and say, it's great, I'm not worrying about it until price gets down here below that 20-week moving average line. What we want to see is, like this, price continues higher and relative strength is supporting that increase in price. And when price goes down, we would expect relative strength to go down, right? That all makes sense. What you don't want to see, or if you see it, you should expect, it's a red flag, is when price is going up and relative strength is going down, right? It's showing you that even though price is continuing higher, it's the momentum behind that price move is weakening. It's not a timing tool. It's just telling you that the rally is weakening, and you always get a weakening rally before the top. Okay, so we don't know when the top is going to be. It's possible that price can continue higher, momentum can shift and start moving back up. It's possible. It's just that right now it's a red flag. S fund also above its 20-week moving average line, but it peaked back here in, I guess, November of last year, and has been struggling ever since, right? We had that gap up in January, and then really haven't moved very much from it at all. So and relative strength is not great. and it's declining. That has a lot to do with interest rates, because as rates go up, S fund is a lot more kind of dependent on lower rates than the C fund is. I fund, like we've been talking about for a little bit, the I fund is the best looking chart in the group, and it's doing what we want it to do. It is so one of the reasons why I said these charts look a little bit different. If you did a chart of the Europe Asia Far East Index in stock charts or in TradingView, we had a triple top back here, and the Europe Asia Far East Index is still not above that triple top. In this chart, it is because it includes dividends. But the point is, we got back above that 20-week moving average line back here, and the dollar has continued down, at least for now. And so I fund has been going up, and we'll see what happens as it tries to break to new highs. And the F fund still, I don't know. Usually I do a bigger chart, but it's getting to be, we've been in this sideways trading range in the F fund for so long now. It's going to be really interesting to see what happens. But obviously, since at least September of last year when we peaked, we've been in this down channel, and the F fund's fighting to try to stay above that 20-week moving average line. Relative strength got above 50, but it looks to be rolling over again. So we will see what happens with the F fund. And then, of course, the G fund keeps on going up and to the right. G fund's about 4.6% annually right now. So if you're concerned about all the things that are going on in the world and the completely upending the apple cart of what's going on in the United States right now, the G fund at 4.6% is not a bad place to hang out and watch the show. All right. Questions?
Questions. And speaking of watching the show, if you do watch this show and you like what you see, please share it with your friends. We put this out on YouTube so people could just share it easily. You can also watch it on our website, of course. And as Jerry's described many times, we have a newsletter that goes out to all of our subscribers on our website every Sunday around 6:30, 6 o'clock. I forget. The show comes out at 6:30. Newsletter comes out a little earlier. And yeah, we really dig into, so this is kind of like a grazing over of what's going on with the TSP funds, and the newsletter gets into a lot more detail, a lot more actionable data, kind of, if you want to call it that. But if you guys like it, share it with your friends, and let us know in the comment section wherever you found the video. If you have any comments, if there is no comment section, you can always shoot us an email at support@growmytsp.com. And Jerry, we will see you here in the studio next Monday, Tuesday, something like that.
Awesome. We'll see you in a bit.